Welcome back to the deep dive. You know, for most of our lives, we are absolutely obsessed with one fear.
Running out of time.
Running out of time. Not enough time to save, not enough time for compound interest to do its thing. But today, we're flipping that script completely. We're going to talk about the nightmare scenario on the complete opposite end of that spectrum.
The fear of not dying soon enough.
Exactly, living too long. I mean, the financial industry has this really clinical term for it, right? Longevity risk.
Yeah, it sounds so sterile.
It does, but for a retiree, staring at the ceiling at 2 a.m., it's not clinical at all. It's that cold sweat moment of thinking, okay, I might live to be 95, but my money's going to run out at 85.
And that is a rational fear. I mean, it might be the most rational fear in modern finance, and it's driving a huge shift in behavior.
How big a shift?
Well, if you look at the data from just a few years back, 2023, Americans poured over $385 billion into annuities. And as we move through 2026, those numbers they're not just holding, they're breaking records.
So people are just chasing safety. But here's the tension, and this is why we're doing a whole deep dive on this. Annuities have this wildly polarized reputation. I mean, you talk to one person, they're a lifesaver. You talk to someone else.
They're a scam, a fee-heavy trap designed to fund your agent's vacation home.
Right. It's arguably the most divisive product out there.
It really is.
So our mission today is to decode all of this. We're working from a really comprehensive guide from Davies Wealth Management. It's called Annuities Decoded, Pros, Cons, and Key Questions for 2026 Shoppers.
Good source.
And we're going to strip away the jargon and just try to answer that one big question. Is buying an annuity just buying yourself a personal pension plan? Or are you walking into a trap?
To answer that, we have to start at ground zero, because annuity is a word everyone's heard, but if you ask 10 people how it actually works,
9 of them give you a blank stare.
Exactly.
So let's unpack it. At its absolute simplest, what is this thing?
It's a contract. That's the most important thing to remember. It's not an investment in the traditional sense. It's a contract between you and an insurance company.
Okay.
You give the money a lump sum, or maybe payments over time, and in exchange, they promise to pay you back later.
And that payback isn't just getting your money back. It's a stream of income.
Correct. It could be for a set number of years, but the real selling point, the thing that drives the whole industry, is the promise to pay you for the rest of your life.
No matter how long that is.
No matter how long.
The Davies guide had this fantastic analogy that it just clicked for me. They called it reverse life insurance.
It's the perfect way to think about it.
Because with regular life insurance, I'm betting I might die too soon. I paid premiums, so if I, drop dead, my family gets a payout.
Right, you're hedging against early mortality.
But with an annuity, you're hedging against the exact opposite. You're insuring yourself against living too long.
You're transferring the financial risk of your own survival from your shoulders to the insurance companies.
Okay, but here's where the business model always confused me. If I give them, say, $100,000, and I happen to have great genes and live to be 105, they're going to pay me out way more than I gave them. They're losing a ton of money on me. How do they not go bankrupt?
And that's the really interesting part. It's a concept called longevity pooling.
Longevity pooling. Sounds like a weird resort.
You definitely want to be in this pool because it means you're still alive. But here's how the math works. Imagine a pool of, say, 1,000 people.
Okay.
The insurance company knows, statistically, that some of those people are going to pass away earlier than average.
Right, actuaries.
When those people die, they stop getting checks. The money that would have gone to them, it just stays in the pool. And that capital effectively subsidizes the payments for the people who live to be 100.
So in the most grim, realistic terms possible, the people who die early are paying for the retirements of the people who live a long time.
That is exactly what's happening.
Okay.
It's a cross-subsidy. And that's why an annuity can offer a payout that's higher than what you could safely take from, say, a bond portfolio.
You're not just getting interest.
No. You're getting what actuaries call mortality credits.
So by buying in, I'm basically making a bet on my own endurance.
Precisely. And you're paying the insurance company to take the stress of that bet off your mind.
All right, so that's the engine. But when you go to buy one, it's not like there's just one option. The source lays out this whole menu. It feels a bit like Goldilocks.
That's a great way to put it. The safe one, the risky one, and the complicated one in the middle.
Let's start with the safe one, the fixed annuity. This seems like the vanilla ice cream of the annuity world.
It is. It's simple. It's predictable. You give them your money. They guarantee your principal, so you can't lose what you put in, and they give you a set interest rate. Very similar to a bank CD.
And in the 2026 market, the guide says the rates are actually pretty good.
They are, yeah. We're in an environment where fixed annuities are offering rates over 5%. For a guaranteed return with zero market risk, that's really compelling for a lot of conservative retirees.
But the trade-off is the ceiling.
Always. If the stock market rips up 20% next year, your fixed annuity is still just chugging along at 5%. You traded that upside for total certainty.
Okay, that's the safe bet. Let's go to the other extreme. The risky one. Variable annuities.
Right, and this is where things get really controversial. With a variable annuity, your money is invested in what they call sub-accounts.
Which are basically mutual funds.
They're mutual funds wrapped inside that insurance contract, yes.
So if the market goes up, I'm not capped. I actually get that growth.
You can make more money, absolutely. But, and it's a big find, but you can also lose money. Your account value can go down.
And on top of that risk, the source pointed out something called fee drag.
It's a huge issue. You're paying management fees for the funds, you're paying insurance charges, administrative fees. All these layers of costs can just eat away at your returns.
Okay, so fixed is safe but boring. Variable is risky and expensive, which brings us to the middle child, the one everyone seems to be talking about. Indexed annuities.
Indexed annuities are incredibly popular because they pitch this best of both worlds idea. Your returns are linked to a market index, like the S&P 500.
So you get some market growth, but with a safety net.
Exactly. But you have to understand the cap and the floor. The floor is the main selling point. It's usually 0%, meaning if the S&P 500 crashes by, say, 30% in a year, you lose nothing. Your return is just zero. Your principal is safe.
I can see the appeal. You sleep well at night.
You do. But the price you pay for that floor is the cap. The insurance company might cap your gains at, say, 6 or 8%.
So if the market roars ahead by 25%.
You don't get 25. You get your cap of 8. You're giving up the home runs to avoid the strikeouts.
And real quick, the guide distinguishes between immediate and deferred. That's just a timing thing?
Yeah, exactly what it sounds like. Immediate means the checks start coming right away. Deferred means you let the money grow for years before you turn on the income stream.
Okay, so we know what they are. Now for the why. Why are people pouring billions into these? What's the psychological trigger?
It really boils down to 3 words. Guaranteed. Lifetime. Income.
The paycheck that never stops.
Think about it. We've shifted from a world of employer pensions, where the company took care of you, to a 401k world where you have to manage it all yourself.
The risk moved from the corporation to the individual.
Exactly. And that's a heavy burden for someone who's 75. How much do I withdraw? What if the market crashes? An annuity lets you buy that pension back.
The guide talks about this idea of a protected income layer. What's that in plain English?
It's a planning strategy. The idea is you identify your absolute essential expenses.
Your keep the lights on money.
Right. Housing, food, healthcare. And you make sure that specific amount is covered by guaranteed income, Social Security, maybe a pension, and then an annuity fills the gap.
So if the stock market tanks, you can still buy groceries.
Your survival isn't tied to the Dow Jones. That's the protected income layer. It separates your survival money from your fund money.
You know, the most interesting pro in the guide wasn't even financial. It was behavioral.
You mean preventing panic selling?
Yeah. It argues that just having that guaranteed check coming in stops you from making dumb mistakes.
Makes total sense. If you know your basic bills are paid, you're so much less likely to freak out and sell your stocks when the market dips 10%.
You can afford to wait it out.
You can. Your livelihood isn't on the line. So that peace of mind has a real financial value.
But there's always a but.
There's always a but. And with annuities, the gotchas are serious.
Let's start with the big one, the handcuffs.
Liquidity. Or the lack of it. That's the massive trade-off. Most annuities have what are called surrender periods.
So your money is locked up.
For a long time. 6, 8, even 10 years.
Yeah.
If you need that cash back for an emergency,
you're going to pay for it.
Big time. The penalties are steep, often starting around 7 to 10%. So pulling your money out means taking an immediate, guaranteed loss of thousands of dollars.
And what about this idea of permanence?
This is the one that really gets people. Once you annuitize, that's the moment you flip the switch from a pile of cash to that income stream. You usually can't go back. It's irreversible.
So if I start my income stream and then 6 months later I get a bad diagnosis and want to give that money to my kids?
Too late. Generally, you can't. You made the deal. You traded your lump sum for the income. That money belongs to the insurance company's pool now.
Wow. That loss of control is the price of the guarantee.
It is. And we have to circle back to the fees. With the variable annuities especially.
How bad can it get?
It gets layered. The source breaks it down. You've got your management fees. It could be 1% to 2%. Then insurance charges, another 1%. Then you add riders, special features, and each one costs more.
So you could be losing 3, even 4% every single year.
Easily. And if the market returns 7%, but you're paying 4% in fees, you're keeping less than half the growth. It's a huge drag on your wealth over time.
Okay, so let's bring this into the present. Why is this a particularly big conversation for 2026?
The economic context. We're in a higher interest rate environment than we've seen for over a decade.
And that's good for annuity buyers.
It's very good because the insurance company takes your money and mostly buys bonds. When rates are high, they earn more. And when they earn more, they can afford to promise you a higher payout.
So you get a better deal now than you would have a few years ago.
A significantly better deal. Locking in a 5% plus guaranteed income for life is a different calculation than locking in 2%.
The source also flags a very specific risk for new retirees called sequence of returns risk.
This is the monster under the bed for anyone retiring right now. Imagine you retire with $1 million and the very next year the market crashes 30%. It's a portfolio killer because you still have to withdraw money to live. You're selling your shares when they're down, which just accelerates the decline.
You're digging a hole you can't get out of.
Right. And the annuity acts as a buffer. It provides cash flow so you don't have to sell your stocks while they're at a low. You can live on the annuity income and give your portfolio time to recover.
Okay, so let's say someone listening is thinking, all right, maybe I need this. The guide has a checklist. What should you look out for?
First thing, the income gap.
Meaning don't put all your money into it?
Never. The advice is to calculate your guaranteed income from Social Security and any pensions. Then look at your essential bills. Only buy an annuity to cover the gap between those two.
So if Social Security covers my basics, maybe I don't need one at all.
You might not. Don't oversell yourself on insurance you don't need. Keep the rest of your money liquid and growing.
Second on the checklist, company strength.
Absolutely critical. You're entering a contract that could last 30 years. You need to be sure that company will still be around in 2056 to cut you a check.
So check the ratings.
Yes. AM Best, Moody's. Look for an A rating or better. You want a fortress of a balance sheet.
And finally, those riders.
Be skeptical. These are the add-ons. Death benefits, long-term care features. They sound great, but every single one adds a fee and makes the product more complex.
It's like the undercoating when you buy a car.
The salesman will always tell you you need it. The advice here is to only buy what you truly need. Don't gold-plate the policy if it's just going to drag down your returns.
So after all this, what's the big takeaway for someone listening right now?
I think it's that annuities are just tools. They're not good or bad. A hammer isn't good or bad. It just depends on the job.
And if the job is growing massive wealth, this is the wrong tool.
A terrible tool for that. The fees and caps will hold you back. But if the job is solving for, I need a paycheck that will never stop, and I can't stomach the risk of running out of money, then it's a uniquely effective tool.
The ideal candidate the source describes almost sounds like someone who has already won the game.
That's a great way to think about it. They've maxed out their other accounts, they are genuinely worried about living too long, and, this is key, they have enough cash elsewhere that they'll never need to break into the annuity and pay those surrender charges.
You're treating liquidity for certainty.
That's the fundamental trade. Yes.
Which brings us to the final thought I want to leave everyone with. We spend our lives trying to accumulate a number, right? $1 million, $2 million. But in retirement, the game changes completely. It's not about the pile of cash anymore.
It's about the stream of income. The shift from accumulation to decumulation.
Exactly. So the provocative question is this. What's the price of your peace of mind? Are you willing to give up access to your cash and cap your potential winnings just for the absolute guarantee that the check will clear every single month until you die?
For some people, that's unthinkable. They want control. For others, it is the only way they will ever truly sleep at night.
And only you can do that math. We encourage you to look at your own personal pension gap. See if that peace of mind is worth the price.
And read the fine print. Always, always read the fine print.
Always. Thanks for diving in with us today. We'll catch you on the next one.